Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. This morning, we're doing our deep dive, really getting into the financial news that's making waves. We've pulled together the key stories from across the major financial publications just to give you a clear understanding of what's happening and maybe more importantly, why it actually matters to you.
Yeah, and as we were looking through those headlines, a few really big themes just jumped out. They're pretty interconnected, too. We're seeing a really powerful market response to shifts in the trade landscape, especially that U.S.-China relationship, how it's evolving. And then there's the tech sector. Just relentless advancement, huge market impact with AI, artificial intelligence really leading the charge there. That's front and center. And then, of course, we're tracking those critical indicators of the broader economy, everything from how consumers are behaving to some, well, pretty intriguing things happening in private equity and government finance.
Okay, right. Let's peel back the layers then, starting with trade, because there have been some notable developments there. It seems the U.S. and China have maybe reached a point of temporarily easing tariffs.
Yeah, that's the headline. And the immediate market reaction was, well, it was quite something.
Tell us about it.
Okay, so according to Bloomberg, we saw an immediate 3% jump in S&P 500 futures. And, for those tracking the market, the S&P 500 is that key index, 500 large U.S. companies. But beyond that, there were widespread rallies in assets considered sort of higher risk, and the big U.S. tech names, the ones in the NASDAQ 100 index, their futures leaped 3.8%. Pretty substantial.
Wow.
Yeah, and the U.S. dollar strengthened, Treasury yields nudged higher too. So this whole reaction, it really suggests the market saw this as a real step back from, escalating trade tensions. That's been a big overhang.
It really is a stark contrast, isn't it, compared to the reaction after President Trump's tariff announcement back on, what was it, April 2nd?
Oh, completely.
If you recall, MarketWatch reported the S&P 500 actually dropped nearly 19% in the week after that news.
That's right.
So this new agreement, even if it's just temporary, it really seems to be providing a considerable sense of relief. What do you think is driving this more optimistic take now?
Well, I think a key piece, and Treasury Secretary Scott Bessent mentioned this, is the shift in tone and, the commitment to talking. He described the discussions as very robust and productive. That's the quote.
Okay.
And coupled with that really crucial statement that, quote, neither side wants to decouple. That signals a kind of fundamental desire to keep the economic ties, even if they still disagree on things.
Right, so it calms fears of a total split in that really complex U.S.-China economic relationship, which, that would have huge negative consequences.
Exactly. That's the reassurance the market was likely looking for.
Interestingly, Bloomberg also pointed out that Volkswagen, the big global automaker, is going ahead with a green hybrid bond sale in Europe. And the article specifically mentioned this is happening because of this improved U.S.-China trade sentiment. And it's expected to kick off a pretty busy week for corporate bonds. How does that tie in?
That's actually a really good connection to make. Volkswagen's move, it suggests that this perceived easing of trade tension, it's not just boosting stocks. It seems to be creating a more stable, more predictable environment for companies wanting to raise money in the bond market, too.
Okay.
When there's less uncertainty about tariffs and trade flows, companies are probably more confident about issuing debt, right? And investors are maybe more willing to buy it.
Makes sense.
So, yeah, it's a tangible sign that this thaw in trade talk can have real effects on business decisions and financial markets generally.
Okay, let's dive a bit deeper into the bond market itself then. The Wall Street Journal had a piece, Tariff Shock Reverberates in the Bond Market. Sounds traumatic. It pointed to some interesting dynamics. What were the key takeaways there?
Yeah, what's really striking, as the journal detailed, is this divergence we're seeing. Longer-term Treasury bond yields, they've been going up.
Okay.
But shorter-term Treasury yields have actually been heading down.
Huh. Why this split?
Well, the article explains it's about uncertainty, specifically uncertainty about future inflation. And a lot of that is being fueled by, the unpredictable nature of trade policy. This uncertainty is increasing what's called the term premium.
Term premium. Okay.
Yeah, basically, investors are demanding more compensation, a higher yield, for the extra risk of holding government debt for longer periods when the future impact of tariffs on prices and growth is, unclear. It's the price of locking up money long-term amid that uncertainty.
So wait, even if the Federal Reserve tries to boost the economy by cutting short-term interest rates,
Right.
these higher, longer-term yields could still act like a brake on growth by keeping borrowing costs high for mortgages, business investment, that kind of thing.
Exactly. Yeah. That's the concern the Wall Street Journal highlighted. This widening gap between short and long rates could really complicate the Fed's job, making it harder to spur growth using their usual tools.
Hmm.
They also connected it back to what they called the Trump trade in treasuries, how the market reacted to earlier trade news. And they noted that when some of those positions unwound, it added to the liquidity stress we saw back in April. MarketWatch mentioned that too.
It really just highlights how interconnected everything
It
is.
really does. It all fits together.
Yeah, it shows how trade policy isn't just about, you know, tariffs on widgets.
Mhm.
It ripples out to inflation expectations, the bond market, even how effective the Fed can be.
Okay, slightly different angle, but still international. Bloomberg briefly mentioned Saudi Arabia's airline Flynas. They're looking to raise up to $1.1 billion in an IPO, an initial public offering.
Right, going public.
Yeah, offering shares to the public. And the article noted this is happening despite the market volatility from U.S. trade policies. What might that tell us? That's an interesting one. Flynas going ahead with a big IPO now. It could suggest a couple things. First, maybe certain regions or specific sectors, like domestic air travel in Saudi Arabia perhaps, are seen as relatively insulated from the direct fallout of U.S.-China trade spats.
Okay, plausible.
Second, it might just reflect really strong underlying demand for growth opportunities in that specific market, maybe strong enough to outweigh the broader global jitters for certain investors. It's just a reminder that these global events, their impact isn't the same everywhere, across all markets or industries.
Good point. All right, let's pivot now. Let's talk tech. It just continues to be such a huge part of the market story.
MarketWatch reported on the resurgence of the Magnificent Seven tech stocks. Remember the April sell-off, partly blamed on tariff fears? Well, now these giants seem to be leading the May recovery. What's behind that strength?
Yeah, the MarketWatch piece definitely flagged their comeback. There's an EPF, the Roundhill Magnificent 7 ETF, tracks these big names. It's up something like 18.2% since the low point in early April.
So what's driving it? Probably a few things. First, that April sell-off might have just pushed some of these quality names into oversold territory.
Right, a buying opportunity.
Maybe. Then, the potential easing in U.S.-China tensions, like we discussed, removes a big potential headache for these massive multinational companies with global supply chains.
Makes sense.
Plus, there's the general resilience of the U.S. economy, the hope we can still avoid recession. That always helps growth stocks. And let's not forget, many of them actually reported strong first-quarter earnings. So their fundamental performance is solid, too.
It's interesting, though. Despite this recent rally, the article also mentioned that tech-related sectors in the S&P 500, broadly speaking, have still underperformed the overall index year-to-date.
Yeah, that's a really crucial nuance.
What does that tell us? Is investor sentiment still a bit cautious on tech overall?
I think it suggests exactly that. While the big Mag 7 names are grabbing headlines with their gains, the fact that the broader tech sector is lagging for the year indicates some caution is still out there. It could mean investors are happy to jump back into these perceived leaders when uncertainty rises, but maybe there are still worries about valuations across the wider tech space.
Or maybe a rotation into other sectors.
Or, yeah, maybe a rotation towards sectors seen as less exposed to global economic swings or trade issues. It suggests the tech recovery might be a bit top-heavy right now.
Okay. Sticking with tech, MarketWatch also had an article just on AI stocks. It referenced a very bullish outlook from Wedbush analyst Daniel Ives. He sounds incredibly upbeat about AI's growth.
Oh, he is. Very bullish. As MarketWatch reported, Ives sees the global AI market hitting, get this, $407 billion by 2027.
$400 billion, that's huge.
It's massive. And he breaks down who benefits into three main groups. First, semiconductors and hardware, the companies building the actual infrastructure, the chips, the processing power needed for AI.
Like NVIDIA.
Exactly. NVIDIA is a prime example there, leading the charge in specialized AI chips. Second group, software companies, the ones developing AI applications, platforms, tools. And third, consumer internet companies, the ones who can use AI to make their existing services better and find new ways to make money from their huge user bases.
He mentioned Apple too, right?
Yes. On the consumer internet side, Apple's developing its own AI features. They're calling it Apple Intelligence, apparently with a big focus on privacy. But as the article notes, Apple's huge global supply chain does make it potentially vulnerable if trade tensions flare up again.
So how exactly do these consumer internet giants cash in on the AI boom, according to Ives' analysis in MarketWatch?
Well, the article laid out a few ways. One is through AI agents, think personal assistants that automate tasks, give personalized info.
Okay.
Another is optimizing advertising, using AI for better ad targeting, better pricing, then making search better, improving content recommendations, that's a big one too. And finally, integrating generative AI directly into their hardware, creating new AI-powered features. That's another exciting area.
And the article even listed specific AI stocks the analyst thinks have serious upside potential. Some of those numbers were pretty attention-grabbing.
They really were.
Yeah.
Companies like Interdata Inc., Elastic NV, MongoDB Inc., they were mentioned with potential upsides based on the analysts' targets ranging from 46% up to 65%.
Wow.
Yeah, and others like SoundHound AI, Salesforce were on the list too. It shows the sheer breadth of companies expected to benefit as AI expands across different sectors.
All right, let's just focus again. Let's talk about the consumer. Always critical, the engine of the economy. MarketWatch highlighted Walmart's upcoming earnings report, called it potentially the most important consumer earnings report of the season. Why so much weight on Walmart right now?
Well, as the MarketWatch article explained, Walmart is often seen as this crucial bellwether for the overall health of the U.S. consumer, especially now with these background anxieties about inflation and how tariffs might hit everyday goods. Given Walmart's sheer size, its reach across so many different consumers, its results, and what its management says, that can give us really valuable clues about spending patterns and just general consumer mood.
And didn't Walmart previously forecast a possible dip in quarterly profit, citing economic worries and higher costs?
That's right, they did. Their earlier guidance was pretty cautious, acknowledging those headwinds. But, the MarketWatch piece also gave a bit more retail context. It mentioned Costco reported higher sales in April.
Okay, positive sign.
And Amazon apparently said they haven't seen any real weakening in demand yet.
Hmm.
Still, the potential for future price hikes because of tariffs on imports, that remains a big concern hanging over retailers and, of course, consumers.
So it sounds like a bit of a mixed bag from the consumer side. Some resilience, but also these underlying worries, especially about prices. The article also briefly mentioned earnings from places like Topgolf, Callaway Brands, and Birkenstock. What can we learn from those kinds of companies more in the discretionary spending zone?
Yeah, looking at companies like Topgolf, Callaway Leisure, Entertainment, and Birkenstock Footwear, they can give us hints about how trade worries and inflation might be hitting spending on non-essential stuff.
Right, things people want versus things they need.
Exactly. As MarketWatch suggested, their reports could show if consumers are getting more cautious with that discretionary spending. And also how these companies themselves are handling potential supply chain issues or shifts in what consumers are buying because of the broader economy.
Okay. Moving beyond those immediate market and sector updates, let's touch on a couple of other significant economic developments. There was a Bloomberg article detailing a somewhat concerning situation with private equity firms and their lenders. Sounds like some friction there.
Yeah, that Bloomberg piece described growing tension, definitely, between the PE firms and the institutions that lend them money. It highlights this trend where PE firms seem to be prioritizing their own returns, using what are called liability management exercises. And these moves are often costing lenders, well, billions.
Liability management exercises. Can you break that down? What does that actually involve, and why is it causing friction?
Sure. As Bloomberg described it, when a company owned by a PE firm gets into financial trouble, the PE firms are increasingly setting up these restructuring deals that create different layers, different tiers of debt.
Okay.
These deals often give better terms on new debt to maybe larger lenders, sometimes even lenders connected to the PE firm itself, in exchange for more capital. But this effectively pushes down the existing debt held by other lenders, lenders who might have thought they had safer first lien debt initially.
Ah, so they get pushed back in the queue for repayment.
Precisely. And as a result, these original lenders can end up recovering much less, sometimes just pennies on the dollar. The article mentioned Tropicana and Newfold Digital as examples of this happening.
So you combine that practice with the potential for more financial distress among these PE-backed companies, maybe because of trade uncertainties, and you've got a real source of conflict for the lenders.
Exactly. Bloomberg noted lenders are getting more reluctant to go along with these LMEs, these exercises. They feel the deals are just too skewed against them now. In some cases, lenders are apparently saying they'd rather see the company file for Chapter 11 bankruptcy.
Really? Bankruptcy seems drastic.
Well, in Chapter 11, the process is more legally structured. It might offer a more predictable, maybe fairer outcome for creditors compared to these complex, and from the lender's view, unfavorable out-of-court deals.
Interesting dynamic. Okay, completely off the topic now. Bill Gates made a huge announcement about his wealth. MarketWatch reported he plans to give away 99% of his fortune. What kind of ripple effect could that have?
Well, as the MarketWatch article discussed, it's obviously a massive landmark moment for philanthropy. It's definitely got people talking. But some financial advisors quoted in the piece think it might not fundamentally change how other very wealthy people give. Philanthropy is often really personal, tied to individual values.
Right.
However, other advisors do see it as potentially influential, maybe prompting more conversations with their clients about, accelerating their own giving or thinking about different ways to make a bigger impact.
Okay. Sitting with big money, MarketWatch also highlighted a persistent and frankly enormous problem: fraud in government healthcare programs like Medicare and Medicaid. The scale sounds just staggering.
It really is. The Government Accountability Office, the GAO, estimates, and MarketWatch reported this, that the federal government might be losing over $500 billion a year to fraud across all its programs.
Half a trillion.
Yeah. And within Medicare and Medicaid specifically, the amount of improper payments is just huge. It's a massive drain on taxpayer money. The article pointed out that fighting this fraud is tough, partly because the oversight agencies, like the Health and Human Services Investigator General, have pretty limited resources compared to the sheer amount of money flowing through these programs.
And this is all happening while there's political talk about potentially cutting Medicaid to fund other things like tax legislation.
That's the political context, yeah. As MarketWatch explained, while pretty much everyone agrees we need to fight fraud and waste, the political ideas on how to manage the overall costs differ a lot. Proposals to make big cuts to Medicaid spending often face significant pushback, even from within the same party, because people worry about how it would affect healthcare access for vulnerable groups in different states.
Right. Complex issue.
Okay.
Okay, one last item from our roundup. Bloomberg reported something interesting from South Africa. Fuel suppliers there are thinking about using trucks instead of the main Transnet pipeline because the pipeline fees have spiked. What's the significance of that?
Yeah, that could be a pretty big deal for how fuel gets moved around in South Africa. Transnet, the state-owned pipeline operator, got approval for a big hike in its tariffs from the energy regulator.
Okay.
So now fuel suppliers are apparently calculating that trucking the fuel inland might actually be cheaper, maybe even faster, despite, the extra complexity, environmental impact of using roads. So this shift, if it happens widely, could really affect transportation infrastructure costs, planning within the country. It just shows how regulatory decisions can really change how businesses operate and manage their supply chains.
It's really fascinating, isn't it, how all these different threads, U.S.-China trade talks, AI developments, consumer spending, PE deals, even fuel transport in South Africa, they all weave together in this complex global financial picture.
Absolutely. Each story gives us a valuable piece of the puzzle. It shows all the different forces shaping economies and markets right now. That temporary easing in U.S.-China tension definitely brought some optimism, but the underlying uncertainties are still there. Tech, especially AI, keeps racing ahead, but it's clearly sensitive to global trade stuff. Consumer spending, so vital, is being watched like a hawk for any signs of strain. And then things like the PE lender friction, the government finance issues, they highlight ongoing complexities in the system.
Well, that's a pretty thorough look at the major headlines shaping our Monday morning. Hopefully this deep dive has given you a clearer picture of these key developments and what they might mean.
Indeed. It really underscores just how dynamic and interconnected everything is in global finance. Nothing happens in a vacuum.
All right, that's all the time we have for today. We'll see you all tomorrow morning with new headlines from major financial magazines.